So we think about that a lot, and I think I have to start by saying it's too soon to really tell, because the answers you would give today, the picture looks very different than what it looked like a year ago. And so, and a year from now...
Stream crashed, but we're going to go over this after he's done talking in about an hour. So join in for the last 15 minutes if you're not watching this live. We're going to go over what stocks are doing while Jerome is finishing up talking.
We should just be prepared to be surprised with the next chapter, as we were with 2023. The very strong growth, the sharp decline in inflation while the labor market remained very strong. Very few forecasters had that, but we can talk about it.
Gentleman's time has expired. We'll now go to the gentleman from Ohio, Mr. Davidson, for 5 minutes.
Thank you, Chairman. Chairman Powell, thank you for being here today and for your testimony. I'd like to start off, first of all, by completely echoing everything Congressman Barr said. A lot of us have talked about Basel III endgame, and I think Congressman Barr kind of nailed the thought process. I do hope you'll kind of withdraw that and take the comments you've heard from here and from so many others about the hazards with the current approach. But I'd also like to, address.
Sorry about that, guys. Crash for a sec. We're back up.
It's the practice of paying interest on excess reserve balances held with the Fed accounts. It's my strong belief that rewarding banks with returns for taking no market risk actually harms our economy, and it discourages financial institutions from lending money into the economy. Instead, they park it at the Fed. This has little to no impact on very large corporations, but it can have a crippling impact on small and mid-market firms. And we especially saw this in the long recovery as Dodd-Frank was implemented in the Obama years, transition to the Trump years. We changed some of that mindset with a lot of other policies, but we saw a strong surging economy. So our country would pay a price for this market distortion by the Fed in 2 ways. First,
like the stream, try to get us back where we were. Sorry about the crash, guys.
Because the money's sucked out of the market. Frankly, a lot of them don't even have.
Wait, my stream crashed?
Except through bank capital.
So is the market going to crash?
Into other forms of capital, equity capital, and others. Second, they ultimately pay higher rates whenever they have these alternative means of capital. And so today, I've introduced a prohibition on the IOER Act, which would prohibit the Federal Reserve from paying interest on excess reserves. By eliminating IOER, we can begin to return our economy.
Coming into the daily expected move for the Qs. Let's see if this can hold as resistance. Breakthrough would be a good thing.
Requirements. We see some of those moral hazards when you do it across the board with approach like Basel. So what's your case for why you should keep paying interest on excess reserves?
Well, as you know, we don't see the downsides that you're talking about. You know, banks have a cost of funds and they have what they can earn, and that's what really matters is the spread.
And if they wanted to do it, they could simply buy treasuries on their own, and they could do that independently. I suppose they can independently keep it at the Fed. But they don't
check out Google for a sec while you're listening.
Balance sheets in the same way. They've got immediate liquidity with Fed overnight account. So I don't see how that's different than what they could already do.
What I was going to say was, you know, banks can earn a much bigger spread by lending to corporates. So their incentive to lend is the same as it always was. This doesn't affect that. You know, really, it's they have a cost of funds and they have the ability to have reserves, but you know that's not going to. They're not earning a profit on that. So or a big one. They can earn a much bigger profit by lending to small corporates.
Well, speaking of profit, I mean, the Federal Reserve isn't officially supposed to be a for-profit corporation, but you are supposed to pay for your operating costs off of positive cash flow. And right now, the Fed doesn't have positive cash flow. In fact, the Fed has negative cash flow. So it's not entirely unrelated that...
you just watch out for resistance here. I think my computer overheated, so I'm trying to blow this thing out a little bit.
And currently is carrying a $133 billion loss on its balance sheet this year. So it's, you know, not the right approach, I think, to be paying essentially that much out in excess reserves to banks that are holding capital in the Fed when they could be deploying it into the market. So right now, the interest you're paying banks and money market funds exceeds the income you're getting on the $7.6 trillion balance sheet assets that you have, to the tune of $133 billion asset. So, you know, effectively, the Fed is operating at an operating loss. So what's the path back to cash flow positivity for the Fed?
As you know, you know, for many years during the QE large balance sheet period, we've contributed way over $1 trillion in net earnings to the bank, which to the Treasury Department. So you can't look at the loss without mentioning that we've been, you know, giving effectively $100 billion a year in profits every year to the Treasury Department. So the other side of that is when we raise rates to do the job you've assigned us to get inflation under control, when we do that, we absorb paper losses. It has no effect on our operating, the way we operate the Fed. And you know, if we retained all the earnings we have, then it wouldn't be a problem. But we don't do that. We give that money to Treasury.
Thank you. And I think the last thing is I just encourage you to halt any effort to develop a central bank digital currency. It doesn't need designed, developed, and it certainly doesn't need established. I yield.
The gentlewoman from Ohio, Ms. Beatty. Mrs. Beatty is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to our ranking member, and thank you, Director Powell, for being here. Let me start by saying thank you for the monetary report. I've had a chance to try to peruse it, and there are headings in there that says the labor market remains strong. You'd probably agree to that, your report.
I would.
Let that say that's a yes. Also, it talks about unemployment rates being low by historical standards. You'd agree with that? It also states that the global pandemic played a huge role with the inflation rate, and inflation rates are on the decline. It's reported in several charts in here, and also substantiated by the Federal Reserve of New York and Michigan surveys that I've read. It also talks about job gains and uses the word robust jobs. So I want to thank you for educating us on that. And Mr. Chairman, I'd like the record to show that all of this...
My old computer is cooking, so I'm going to do this breakdown real quick. Make sure to keep that stream up on your side of things. Just want to bring up the fact that on the SPY here, coming up into resistance, well, we're starting to blow through that right now. So we're going to do our little breakdown right now, if you guys don't mind. Is everyone cool with that? We're going to do a little bit of a breakdown. So keep that live stream up if you want to watch it, but I'm going to give you guys this breakdown because my computer's just like wanting to blow as hard as possible right now. So I need to get a new one. So like and subscribe to hopefully fund Luke to get a new computer. You know what I mean? I like my little $1,500 laptop that I use for, well, I've been moving around, but I need to get myself a real PC for doing this type of stuff. Now, to the upside here, remember that we're at that daily expected move. Look for that resistance to come in. We could fill this gap, then see that resistance come in. But we could also be making another point. So this is where I want to bring up a 30-minute. We saw that cross. Look at that. It's getting into positive territory. What did we say around this area? Well, if we start to see positivity around here, this is when we're going to get into positive territory. So we're looking for if that's going to fade, or if we're going to create another point of divergence. We mentioned it could go higher. Remember, trap down here, trap up here, trap down here, trap somewhere up in here. This is what we're overall looking for as far as the price action goes for right now. Similar thing with the Qs, trap down here, trap up here, trap down here. Now we get this daily expected move push. If we're able to push through that with some things participating like Google, I'll show you guys Google real quick. 30-minute, a little divergence down there on the 30-minute, but the 15 minutes, what I'm looking at, oh my goodness, we have a divergence here, just confirmed, a little bit of a buy signal, still below the 200 on the 15 minutes, so be a little careful there. But if it's able to break out of this consolidation, we can see this head up. Gonna target 141 if that's possible. If I want to take a short-term trade, I'll probably be looking at this, but this is a good little setup here. Now you have to see if this is going to continue, right? This has really been dropping off, so be very careful with this one. It might be one that you just get in, you get out, and you're done with it. Now going over to Apple, still not seeing any positivity from Apple. I'm sure you have a 5-minute divergence down here, but look at this MACD behavior. If it's able to keep going into positive territory, you have that chance, right? You have that chance, but if this wants to roll over again, good chance we're heading lower. In Apple, as we tune over to Amazon, this was kind of interesting. We weren't able to fully complete the cup and get that handle at higher levels. We actually saw that break back down. Could see some double bottoming here. You're starting to get into positive territory. We could start to creep up if we keep that good news going. Tesla seeing that drop off, but notice this, we now have a 30-minute divergence. You have a 30-minute divergence, a single one here, you have a triple one down here. So we could be seeing a bounce in some stocks to lead the Qs a little bit higher, really dependent on what they're saying over there on that live video. NVIDIA here, the thing we want to pay attention to is if this starts to roll over, right? We pointed out the 30-minute, look for that divergence to form up in this area somewhere around 900. That looks like that's happening. So we gave you guys the upside of the daily expected move because guess what? We're already outside of that at this point. If we set up this divergence here, we're going to be pretty close to that negative territory. Maybe this actually starts to flip the other way with some kind of head and shoulders with this base. So really pay attention to this base on NVIDIA. But we can go to 900. We can see this thing. If people keep trying to short it, we can see it go higher. AMD is a good example of this as well. We haven't hit that upside expected move. Okay, we gave you the expected move for this one as well. 217.10 to the upside. Look at this. It's like a handle, which is above this area, but still a handle in here. So you got the cup. Here's your handle. We can head a little bit higher, maybe target something like 220 and then see that start to fade. But really looking for the signal when it does actually cross, that will be a signal that the momentum's dying out and we can get some bad news. Selling might be in people's mind. Meta, we're getting a pretty good cup and handle here. Didn't want to create the cup and handle at this level, actually gapped above that important area. Very cool thing to see from Meta here, actually completing a cup a little bit higher up, right in line with this liquidity here. So we'll have to see if this can make one more push higher. Look out for that divergence on Meta as well, though, if we go higher, because you'll be right next to negative territory. That's a good sign there. Palo Alto dropping off, Microsoft, Google starting to see a little bit more of a bounce, but overall, someone did point out the volatility today. Volatility, the thing with this is it crossed up in positive territory. That's why I hedged. I hedged live while you guys were watching because, well, if I see volatility cross up in positive territory, that means we can see a big move in the VIX, means we can see some drop-offs in the overall market as we are approaching. This is kind of what you have to do. You have to tie it together. The VIX starting to pop higher, cross on this MACD as we're at the upside of the SPY's range for the day. Not the best sign. Doesn't mean we can't go higher. We were really talking about this 2 hour, seeing that kind of roll over, but right now getting rejected. So if this wants to actually roll over on the 2 hour, we might see some positivity for a couple days, maybe come and fill this gap, something like that before we actually see volatility come in. But this 30-minute ticking up, not the best sign for some bulls here on the VIX side of things. Now we've seen those yields drop off. Tech stocks are really, really liking that. Let's pop over here real quick. We're seeing that resistance start to come in right where we expect it. What did you do for the hedge? I took a very small short position on something that can crash really fast. That would be AMD. That is my, hey, this is going to get ripped away play. I'm telling you right now, I have like maybe 1%, 2% of my portfolio in that trade. I just took a month out position. That way I have time. I kind of just took a position trade there so I could have some time on that. But I wouldn't suggest doing it. The reason that I'm doing it with AMD is because it can see extreme volatility, and it's showing me a 30-minute divergence that could cross, and I'm seeing the VIX cross up. So my hedge is take a small position in AMD that'll cover any losses that I do have. As I am still paying attention to some kind of pop in Google, planning on just getting out of that pretty quick once I make 50% or something like that. Still very small plays I'm making across the board. This is a very volatile time. I mean, volatility is starting to creep up. It's a very trap-like time. Trap down here, trap up here, trap down here. Now the trap could be here. That's why I'm being a little bit cautious at this level. And then if it wants to push higher, let's say AMD wants to push higher again, look like it's doing right now. So now my option's losing money, but that's okay. If this wants to push higher, I am completely comfortable with adding to this position, still comfortable with where my position is at. So hopefully that was helpful. I know we didn't get to watch the last part together. My computer's acting up, and I actually crashed for a moment there. So just wanted to say, I really appreciate you guys coming by. I hope you guys have a great day trading. Watch the rest of that, and I'll pay attention to it. If I see any setups, anything like that, I will most likely be publishing that to Patreon. Not a good sign, though, that we're starting to reach these upside ranges for any kind of calls. Even that Google play that I'm looking at, a little bit hesitant on this one as we're seeing us hit the topside range. So be a little bit careful out there. Join back for my video tomorrow night, and we will be back here tomorrow to watch Jerome Powell again. Right now, just seeing if this head and shoulders will actually play out, and then most likely see a reaction. And I'll be getting out pretty quick. I really think things are going to turn around over the next couple of days, but doesn't mean it has to. So we still follow the trends. We still follow the signals. Thanks for your effort. Good one. Thank you guys so much. Like, subscribe, do all that good stuff. Really appreciate you guys coming by. Tate, thank you for joining. If you're thinking about joining the Patreon, please do it because it's great in there. And I'm going to be giving update videos throughout the week, giving you guys some possible setups with these ranges. So really appreciate it. Thank you guys as always for joining. Really, really do appreciate it. I can't say it enough. And I hope you guys have a great day trading out there. Stay safe. Be willing to trade like water. Really be willing to flip and move with whichever way the stream is going. Because we're going to see bigger swings. And if you're good at it, this is where you can make a lot of money. You guys know my trades have been doing really well over the past, like pretty much since here. I've made money this way, and this way so far. So if you're good at it, you can really pay attention. I'd really just be looking for the cues here. If this starts to roll over, like we said in the video, well, look where that MACD is. It's in negative territory, so good shot. You're going to take out this base once that actually does cross. So thank you guys so much for joining. Really appreciate it. Hope you have all the luck in the world trading today, and I'll see you tonight for YouTube video. Peace.
right now, waiting for some clarity.
You know, we're well aware of the commentary, and we're going to react appropriately. I don't know that we can pull one thing out of line and deal with it. But you know, we're making good progress, and I think we'll be back reasonably soon with some answers.
Okay, well, time is of the essence. Appreciate anything you can do. Second thing, good thing about going late here, you get to follow up. I want to follow up on your discussion with Congresswoman Garcia here. I really appreciated your comments in the 60 Minutes interview last month when you mentioned that immigration is a big part of the story of the labor market coming back into balance. Now, generally, and correct me if I'm wrong, more immigration is generally going to ease inflationary pressure. Is that all else equal? Is that a safe characterization?
You know, it's probably closer to neutral, actually, because you know, people come in, they also spend, you know, so it's not clear that immigrants coming in, they add to GDP.
Okay, so either we're going to get economic growth and or downward pressure on wages.
More workers, so that wages might go up a little bit less, but at the same time they're also spending. So we had this conversation. It depends on what you assume, but I think it's better to just assume it's sort of broadly neutral from an inflation standpoint.
So I guess, and maybe you've answered the second question, but given as you all are using the Census Bureau data that is more conservative than the CBO data, and obviously we're all making estimates in the future, can you speak at all to whether your forward views on economic growth and inflation, how sensitive are they to your assumptions about that census versus CBO data on what the actual level of immigration is to the country right now?
I think the CBO assumptions are meaningfully higher and would affect growth and would be part of the explanation why growth was strong last year and would be a reason to expect. I mean, it's not the main reason, but it would definitely add to growth this year. And I wouldn't say that we accept one version of the other. We're studying. We study the CBO numbers carefully. We're just trying to get to the right answer. And but I mean, I think the CBO shows, and they say so, stronger growth, higher growth, more people. I don't know the per capita growth goes up, but the absolute level of growth goes up.
Okay. Last question. I think there's a lot of good news in the monetary report that you all just issued around wage growth. We've seen